Ever felt like the Wild West of finance is colliding with the rule book? Well, you're not alone. Over the past few years, the world of cryptocurrency has exploded, bringing with it incredible innovation and, let's be honest, a fair bit of regulatory uncertainty. And right in the thick of it all, navigating these choppy waters, is Kraken, one of the biggest names in the crypto exchange game. But recently, Kraken has found itself in the regulatory spotlight, and the ripples are being felt across the entire crypto landscape. So, what exactly is going on with Kraken, and more importantly, what does it tell us about the future of how governments around the world will be keeping an eye on your digital assets? That's what we're diving into today. To understand the current situation, we need to rewind a little. Cryptocurrency, in its early days, operated largely outside the traditional financial system. This was part of its appeal, a decentralized, peer-to-peer form of value transfer, free from the control of banks and governments. But as crypto gained mainstream traction, regulators started to pay closer attention. Concerns around investor protection, money laundering, and systemic risk began to surface. Different countries have taken different approaches. Some have been more welcoming, trying to foster innovation while implementing sensible safeguards. Others have been more cautious, even outright banning certain crypto activities. This patchwork of regulations has created a complex and often confusing environment for both crypto businesses and users. Now, let's bring Kraken into the picture. Founded in 2011, Kraken has grown into a major global cryptocurrency exchange, offering a wide range of services, from spot trading to staking. It has built a reputation for security and reliability, becoming a go-to platform for millions of users worldwide. However, even established players like Kraken aren't immune to regulatory scrutiny. Recently, Kraken faced action from the U.S. Securities and Exchange Commission, SEC. The SEC alleged that Kraken's staking-as-a-service program constituted the offering of unregistered securities. Wait a minute, what exactly is staking? In simple terms, staking is like earning interest on your cryptocurrency holdings. By locking up your crypto for a certain period, you help to secure the network and, in return, you receive rewards. Many exchanges, including Kraken, offered users a way to easily participate in staking. The SEC argued that these staking programs are essentially investment contracts and therefore fall under their jurisdiction as securities. They contended that Kraken was offering these services to the public without properly registering them, thus depriving investors of important disclosures and protections. In February 2023, Kraken reached a settlement with the SEC. As part of the agreement, Kraken agreed to discontinue its staking services for U.S. residents and pay a $30 million penalty. This sent shockwaves through the crypto industry. Why was this settlement so significant? Firstly, it signaled a clear intent from the SEC to assert its authority over certain aspects of the crypto market, particularly yield-generating products like staking. It suggested that the SEC views these services as akin to traditional securities offerings and expects crypto platforms to comply with existing securities laws. Secondly, the Kraken settlement raised questions about the future of staking in the U.S. For many crypto investors, staking is an attractive way to earn passive income on their holdings. The SEC stance has created uncertainty about which platforms can offer staking services and under what conditions. Thirdly, the case highlighted the ongoing tension between innovation in the crypto space and the need for regulatory oversight. Crypto companies often argue that existing regulations are ill-suited to the unique characteristics of digital assets and that overly strict rules could stifle growth and drive innovation overseas. On the other hand, regulators emphasize the importance of protecting investors and maintaining the integrity of the financial system. But the Kraken staking issue is just one piece of a much larger puzzle. Across the globe, regulators are grappling with how to best approach the crypto market. The European Union, for example, has recently passed comprehensive legislation known as MiCA, Markets in Crypto Assets, to create a unified regulatory framework for the bloc. This covers everything from the issuance of crypto assets to the operation of exchanges and stablecoins. Other jurisdictions are taking a more tailored approach, focusing on specific areas like stablecoins or central bank digital currencies, CBDCs. The UK, for instance, is exploring ways to regulate stablecoins and integrate crypto into its broader financial services framework. In the US, the regulatory landscape remains somewhat fragmented. While the SEC has been active in enforcement actions, there is ongoing debate about which agencies should have primary oversight of different types of crypto assets and activities. Congress is also considering various legislative proposals aimed at providing greater clarity and establishing a comprehensive regulatory framework. So, what does all of this mean for the future of crypto regulation? Several key trends seem to be emerging. Firstly, increased regulatory scrutiny is likely to continue. As the crypto market matures and becomes more interconnected with the traditional financial system, governments will feel greater pressure to establish clear rules of the road. This means more enforcement actions, more guidance from regulatory bodies, and potentially more comprehensive legislation. Secondly, there's a growing push for international cooperation. Given the borderless nature of cryptocurrencies, it's becoming increasingly clear that a coordinated global approach is needed to effectively address issues like money laundering and tax evasion. International bodies like the Financial Action Task Force, FATF, are playing a key role in setting global standards for crypto regulation. Thirdly, the focus is likely to shift towards consumer protection and market integrity. Regulators will be looking to ensure that investors are adequately informed about the risks involved in crypto and that markets are fair and transparent. This could lead to stricter rules around disclosure, custody of assets, and prevention of market manipulation. Fourthly, the distinction between different types of crypto assets and activities will become increasingly important. Not all cryptocurrencies are created equal, and different use cases may require different regulatory approaches. For example, stablecoins, which are designed to maintain a stable value, may be subject to different rules than more volatile cryptocurrencies. Similarly, decentralized finance, DeFi, protocols, which operate without traditional intermediaries, present unique regulatory challenges. The case of Kraken and its staking services provides a valuable insight into this evolving landscape. It highlights the willingness of regulators to apply existing securities laws to new crypto products and services. It also underscores the need for crypto businesses to proactively engage with regulators and ensure compliance. With that said, thanks for watching, and until next time.